What's up? Welcome back. 3-minute morning market updates. I'm back. Zach Howard here. It's Tuesday, June the 3rd. Let's go. What's in the notebook to start? Japan. Japan, the biggest non-domestic holder of U.S. Treasury debt. Japan has been the one with the money printer, that yen money printer, financing deficits in the U.S. for the last decade plus with their fiat money printer, the yen. So last night we had a Japanese government bond auction, the 10-year JGB, 2.6 trillion yen, but in US dollar terms, roughly 18 billion US dollar convertible. 10-year yield in Japan, 1.51%. US 10-year yield, 4.4%. It continues to move up in Japan, like all around the world, rising yields, okay? Like we have rising yields because there's so much monetary debt out there, but also global growth continues to accelerate in the backdrop of depreciating fiat money everywhere. 1.51%. The previous auction in Japan was 1.27. It was actually a good auction. The bid on the auction was the best since April 2024. So a lot of demand. So investors that were previously parking money in fixed income in U.S. markets and other markets were saying, you know what, Japan got an extra real yield now. The currency is actually strengthening in Japan. Weaker U.S. dollar, stronger yen, 1.41. So investors were saying, you know what, I have an option here for a change. Maybe I don't need to buy U.S. treasuries. On to the U.S. The summer of George from the Costanza episode of Seinfeld years ago. Do the opposite of whatever you think was going to be bad. Actually turns out to be good news. And yesterday, we kind of had a not so great news, but markets rallied. When you see markets rallying on not so great news, that's a very strong signal for this bullish trend that continues to manifest in U.S. equity markets, continues to manifest in all these mega cap stocks. And we see the outlook for Q2 into Q3, growth and inflation accelerating. Fiscal spending in the U.S. is not letting up. That is not going away. They tried to go to rehab for about 30 days. Scott Bessent figured it out. He's not driving the transport truck off the cliff. He's going to keep it on the highway and try to gear down slowly, but he got to keep spending the money. The U.S. government is just so big it can't. So the fiscal dominance is going to continue to accelerate fiat debasement and thus the monetary illusion that the economy is doing well. What does that mean? When the growth is accelerating, inflation is accelerating, bid to risk assets. The actual inflationary effects of that means higher beta trades, like stocks, like these mega cap stocks, U.S. equity indexes like the NASDAQ, they will continue to outperform, whereas lower beta trades don't do as well in that environment. We're seeing bond yields continue to accelerate and support that thesis. In my notebook, we have all those mega cap trend, the Mag 7, continue to show all bullish trend, higher highs, higher lows, except for Apple at this point. The acronym is TACO. Trump always chickens out until he doesn't. But for now, the market is calling his bluff and saying we got to do risk on. Stay tuned. I got a couple really good presentations, long form, coming up later today and tomorrow. Give me a comment down below what you like to see in the content as I keep creating this channel and building out. Have a great day. We'll see you tomorrow.